Hey guys, my name is Ernest. I will be your host for this next video that we're going to do. So again, I want to take this time to welcome you that going to watch this next video. So we're gonna get it started. We're gonna get right into it. So if you like it, give it a thumbs up. If there's something you like to see next, don't forget, you can leave a comment, and I would love to see your comments then to see what I can do for you next. So let's get to work to continue the journey, the session. Hopefully you did have a chance to watch the first video that we put in. Now we're gonna move on to the next segment. Because remember, this is based on your SIE, so we'd love for you to be able to go and pass that exam. I hope you read the disclaimer, just don't just focus on just this content, because this content is very limited. So now let's talk about why companies issue security. Let's talk about that. So why companies issues security? Why corporation? Okay, why they issues securities? Why they do that? A company issues or sells securities to raise money. They do that to raise money, capital. Then when they wanna, let's say maybe they wanna go ahead expand, they can issue security. So they take that money, they can do various things with it. Maybe they might have some initiative they want to do. Maybe they want to use that money to fund a new products. Maybe they want to use that money for product lines. Okay. Maybe they want to use that money for growth because they want to grow in the company. Maybe they want to expand their operation. Or maybe they can issue those securities so they can pay some debt. I want you to understand why they do that, because the companies, they cannot just go ahead to everybody or any individual investors, let me get your money for such and such interest rate and I'll pay you back. So there is a way they do it. The way they raise money is by issues securities to the investors. They do that in two main ways. There's two ways they do that. There's other way they might do it, but those are the two main ones that we're gonna cover into these topics. They sell equities, securities, such as stocks. What we call, if you see the word equity, it means stocks. And if you see the word stocks, it means equity. And when you see the word stocks, you can also see stockholders, shareholders. Those are the people that own those stocks. Or the second way they can do it to raise money, they can sell debt securities, what we call bonds. And if you see bonds, it also means debt security. So when your company sells stocks, that they don't owe you any money, they don't owe you any profit. So you have a potential to make a lot of money, because that stock can from zero to -0 all the way to positive infinity. That's meant to a number nobody expects. This stock can do that. But they don't guarantee you that. They don't guarantee you profit. But on the opposite, a debt security, when they sell that to the investor, they have to pay you. It pretty much just like you lend your money to a company. So they borrow money from you. So if I put in a sense like this for you, when you get stocks from a company, pretty much say, here's my money, use it. Hopefully your company become a great company. The stock that I purchased, if I purchase a stock at $10 a share, it can go to 15, 20, 100, or 200, even $1,000. Or at the same time, you have to understand the money can go down to zero as well. But the debt security is where you say, I have this money, I want to lend you this money, and you got to pay me. I don't care you make money or not, that's your problem. I'm gonna make sure that I let you borrow my money, so you owe me money every single month, or every 6 months, or every year, depending how the contract is. So they sell debt security. So those are two ways they raise money. There's other way they might, but those are the two ones we're concerned right now. All right. Now let's talk about what we call stock securities. We call stocks equity securities. Okay. They also call them equities. Now, have you ever heard people say, well, I want to check what equity that I have in my house? Since the house is yours, it's a personal home, so they don't call it, it's not a security. But now people say that equity, let me see if I got equity into this house. When what they're saying is how much ownership, the ownership, because when you see the word equity, stocks, you mean ownership. So how much ownership do I have here? Because when you purchase a house, folks, maybe the first time when you start getting that house, okay, maybe after you make the first payment, maybe you own a few doors and windows. Then after you continue to make more payment, maybe you might start owning all the doors and all the windows. Until now you can own like maybe a couple rooms. Until you're done paying the house, now the house belongs to you. Now you have full equity in that house, full ownership. Okay, so that equity, that's another way they can use it, equity. Okay, but stocks, think of it as equity. So ownership. So you have some type of ownership in that company, because the company willing to sell part of their company to the investors. That's what you're buying. You're buying a share of the company. You're buying part of the company. That's what, when you're buying stocks, that's what that means. So you represent ownership, like I said, or interest into a corporation or a company. So it's an interest, it's an ownership in that company. They issue by corporation. Pretty much all corporations, most of them, okay, they issue equity securities, okay? So they, once it is a corporation, they're gonna issue that stocks or equity, what we call it. But there's two main one that company usually issues. It's common stock and preferred stock. Think of it just like I said, when something is common, it's when everybody have the benefit of it. It's common stock, everybody can participate in that. Preferred stock is for preferred customer, if I put it that way. So it's a preferred stock, but there's a slight difference between those two. When we get to more details, and we're gonna be able to explain the difference between common stock and preferred stock. Now, individual investors can participate in the company success by purchasing shares of the stock. So when you're buying the stock, you're buying part of the company's success. So you're hoping this company gonna become so well known, it's gonna make so much money, and the value of your stock's gonna go up, and you're gonna make money like that as well. Now, this stock can also pay some dividend, okay, but it's not a guaranteed dividend, okay? So if the board of directors say, you know, they're gonna issue a dividend to all the stockholders, or what we call the shareholders, and you can get that dividend. And we're gonna explain that when we get to deeper into that learning. They call equity because they represent ownership in a company. So you have equity in your home as well, because you have ownership in the house. So same thing when you buy a share in a company, you have ownership in that company because you're buying the shares in that company. You're buying that stock, the equity. So the equity refers to the ownership that you have into that company. All right, we're moving right along. Now, when it comes to stocks, they classify them, okay, different ways, okay, different, depending on the company, they're gonna put them into a different category, okay. That's when it's type of like, it's kind of a little bit of asset class in a sense, but we're not gonna go to all that details like that. But they're gonna class them based under pretty much value, okay. Common stock can be classified as, okay, they can classify them authorized, okay. They put them like issues. They also That's something called outstanding. And there's another thing we call treasury. We're gonna go to those one, detail by details, how they classify them. Okay, the common stock, the way they classify the common stock, so you can have a pretty good understanding. Let's talk about the authorized stocks. What is authorized stock? So the word authorized stock, what is it? Authorized stock or authorized shares refer to the maximum number of shares that a corporation is legally permitted to issue. So an authorized stock is the quantity of share they allow to issue. For example, let's say XYZ Corporation want to issue 1 million share. That's what they authorize them. Okay, they authorize them to 1 million share. They file with the SEC. They wanna they wanna sell part of the company, but they wanna take like 1 million share put out there to the public. 1 million. So the SEC and the regulation, the US or whatever, they authorize them that 1 million share. But they might say, oh well, based on your company, we cannot authorize you 1 million, maybe 500,000. See? So they might ask for 1 million, they might give them less. But usually they might say, okay, we authorize you to do that. Because they do to waste the money. 1 million share. That's what the amount they authorize them. 1 million share. Now that's the amount of, that doesn't mean, okay, those shares, it's going to be in the public hand yet. They just authorize them. Okay, as specified in the article of incorporation in the US. Or in the company charter in other part of the world. But note, authorized shares should not be confused with outstanding shares. Because I don't want you to confuse when a share is authorized than the outstanding share. So let's talk about this issue, so then we're gonna see the difference between authorized and outstanding as well. Issue stock. What is issue stock? So remember, they authorize them 1 million shares. Let's say that they go ahead and they issues 750,000 shares. That's when they didn't do all the million. Even though they be able to put all of that, they got 1 million they can put for sale, but they only choose to put 750 for sale. So that's the issued stock. Now that stock is for sale. Now people can go buy it. That's what that means, issue stock. It's just like somebody could go buy, go to a dealership and they authorize them to sell 50 vehicles. But in that 50 vehicle they authorize them, they say, you know what? Since we got 50, we don't know. Maybe we might keep some. We don't want to sell some now. So from that 50 they give them to sell, they only put 25 into the market. So the issue would be 25. Does that make sense? I hope that do. I hope you got that. So issue stock is authorized stock that has been sold to the investors. So that stock is putting for sale to the investor to grab. Those investors have bought the stock and the company has received the money. So when they issue the stock and they sell it. So when they authorize, they don't sell yet. But when they issue the stock, that stock has been like, they put it for sale, now it's sell, now the company make the money. Now that money go directly to the company. So when a company issues stock and that stock bought by the investors, that money go directly to the company. Nobody else, but it go directly to the company. That was the whole purpose. They issue that they issue the stock so they can raise the money. They can take that money and do whatever they need to go. They're going to do. But there's unissued stock. Unissued stock. Remember I told you it was 1 million, but they only issue 750. So there's 250 unissued stock. So the other 25 card that I was explaining, that's unissued card because they did not issue those cards. They didn't put them, they didn't sell them, they didn't put them for sale. So unissued stock are shares that's authorized, they authorize them, but they're not sold yet. They are in the company account, in the company assets still. Later on, they can come in and they can issue those stocks, but it's up to the company. And they might not issue them, never. It's up to them. If they want to waste more money, they can go ahead and do that. So issue stock, that stock that's already sold to the investors, now the company have the money directly. So if they ask you a question, who get the money when a company issues stock? The company, the corporation get the money, not the investor, not another investor. The company does. Note, now the issue stock does not carry rights and privileges. So they are like blank checks on the checkbook, which are ready to use when needed. So what that means is if the company wanna, they got those blank checks, which is the unissued stock, they wanna raise money again, they can just go ahead, write those checks, or issue them, and investors gonna buy them. In the company, that money gonna go directly to them again. But you also got to remember, and not only they just blank checks until they put a price on those paper, they're just like paper, unless they put something on them. They're just a piece of paper. And they're not part of the company total capitalization. So when we get to capitalization, a company is talking about mid cap, large cap, small cap, that doesn't count. The unissued stock does not count in the market share. That does not count. So hopefully the issue stock, you understand what it is now. Outstanding share, remember? Otherwise, don't confuse otherwise. Because a lot of people go to that example, probably they think otherwise shares is the same, or called otherwise stock is the same like outstanding stock. No, actually outstanding stocks is a little bit different. Outstanding stock includes any share that a company has issued and are in the hand of the public. You heard that? So if a company issue 750 and the investor purchase all that shares, so the outstanding share it's 750. The otherwise shares is 1 million. The unissued stock is 250. Does that make sense? The outstanding is what the public already got in their hand. Now the investor have those shares. Now the investor can go ahead and sell them to get the money. Whoever want to buy them can buy them. That doesn't mean the company have to buy them. Whoever want to buy them can buy them. So they can trade into the secondary market. Now we can later on talk about primary market and secondary market. We're gonna get to that. But right now, those shares can be traded into the secondary market with other investors. Sometimes a corporation buys back its outstanding stock. When that happens, that stock is no longer outstanding. So not only they get all those shares, they authorize them, but they also can go back when they issue that stock and the public buy that stock, and now the public, the investors selling the stock, the company actually can go back and buy them. And when they do that, it's no longer outstanding when the company purchased that stock. And we're gonna tell you what that means. And note, not all issue stock is outstanding. Okay, not all issue stock it's outstanding. Because if some of that stock, so if some of the issued stock is not in the public hand, so it's not outstanding. So not all issue stock is outstanding. Make sure you understand that. Now, there's something called treasury stock. What is a treasury stock? Remember earlier when I talked about the company, now the investors selling the shares. XYZ Corporation go back and purchase the share back from the investors. Now the investor got the money. Now the share go back to the company. This is called treasury stock. So treasury stock, it's a company, okay? When the company issue that stock and they go back and they reacquire or bought them back from the investors. Okay? So do you guys really understand now what happened So that's the reason when people come in, you got to say, okay, if somebody come in to invest, you need to know those little concept when you come to the exam, so you'll be able to pass that exam. Okay, so many people sometimes they come in, okay, well, I do want to invest. Okay, that makes sense, you do want to invest, no problem, but you need to understand what those things actually mean. Because when you don't know what they mean, you must say, and you get confused when you get to the exam. Now you're confused. Okay, what is authorized stock? What is issue stock? What is issue stock? What is outstanding stock? And what is treasury stock? So one of the things you don't confuse, and this can be tested as well, because sometimes they need to understand, okay, when the company go ahead and purchase this stock, what does that call? Okay, I told you. Is it treasury stock now? Because the company bought them back. Now the corporation can hold this stock forever. Or maybe they can decide they can reissue that stock. Or maybe they can, maybe retire this stock. They can do whatever they want. Because the company can choose to do whatever they want to do. Okay? They can retire that stock. Now, treasury stock does not, make sure you know, treasury stock does not carry the rights of outstanding common share, like voting rights, okay, preemptive right to receive dividend. They don't have that because the company bought them back. So good luck, company. You do that, but we're not gonna give you those benefits because now you purchase this stock, you put it back into your basket. That's called treasury stock. So understand, if you find a test question, say, when the company go back, we acquired the stock, what does that call? Make sure you don't say outstanding. Make sure you say it's treasury stock. So they purchase their own stock back. So that's why a lot of time when people come in, and you have to really understand, okay, what can I do, okay, to raise what a company, let's put it this way, what a company can do to raise money if they want to raise money. Okay, they issue securities. That's what we mentioned to you in the beginning. They issue security. But sometimes we go to that exam. The exam is not like, it's not complicated, but it's challenge. Okay, the exam is a bit challenging because when you go take that exam, they try to trick you and they make the question very difficult, and you have to be paying attention so you can be able to know what they're asking. Okay, so now you understand what is the security is. Okay, now you understand. Now we start getting to know the different type of security. Okay, now you should have a little bit idea what a common stock is, why they issue that stuff. Okay, it's to raise money, and how they classify them, so you know what. And because remember I told you 1 million shares authorized, the company just go ahead and issue 750. Okay, I'm just give you scenario. Okay, and there is 250 that's unissued stock. They can reissue them. They can issue those stock later on. And the public purchased the 750. That's 750 outstanding now. They issued the 750, but they purchased the whole 750. The 750 is outstanding as well. Unless they didn't purchase, they only purchase half, and that'll be, if the investor only purchased half of it, then that'll be half a million will be outstanding. But because if they purchase all of it, and all of it become outstanding, and the company can go back and purchase those shares when the investor put them for sale, and this is called treasury stock. Hopefully that's helped, and I'll see you guys at the top because the bottom is too crowded. Hopefully that's helped.